It's the 8th of May 2021. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 and a few other stock markets from around the world to discuss the possibility that an 80-day cycle trough has formed in those markets. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. So here is the S&P 500. This is the analysis that we've been tracking in the S&P 500 for several months now. Of course, the big event was the 54-month cycle trough in March of 2020, possibly an even longer cycle trough, but according to this analysis, it was 54 months. Then we had a 40-week cycle trough over here at the end of October last year. Then the 20-week cycle trough that formed at the beginning of March. And now the question is, what has happened in terms of the price action of the last week? If we take a look at the foot of the chart, you can see that we have a nest of lows for the 80-day cycle trough round about now, and we'll zoom in a moment. And of course, the next big event is the 18-month cycle trough that we are expecting to happen just after the middle of this year. Here we can see in more detail the 80-day cycle trough nest of lows. And just a reminder, if you're new to this, what a nest of lows is, each one of these circles over here represents the point in time at which the next trough of that particular cycle is expected to form. We call that the circle, and to each side of the circle are these lines, which we call the whiskers. So this circle and whiskers combination represents the range of time in which it is reasonable to expect a trough of that particular cycle to form. Because of the fact that these cycles are synchronized at their troughs, we get what is called a nest of lows, which is this sort of stack of circles and whiskers. And you could in fact calculate a center of gravity, as it were, of the actual circles, which is something that Sentient Trader does in terms of forecasting when we are expecting the next trough of a particular cycle to form. These nests of lows tend to form triangles standing on one of their points at the foot of the chart, and the center of that triangle, center of gravity if you like, is really the exact point at which we would expect the cycle trough to form in the market. This is a nest of lows for the 80-day cycle, and so we were expecting an 80-day cycle trough to form at around about this time. As market action unfolds, of course, we are updating our Hurst Cycles analysis at the end of every bar with each new piece of information. And you'll notice an interesting thing has happened to this analysis, which is the placement of the 40-day cycle, which is in a fairly questionable position because it's over here. And I discussed the position of this 40-day cycle in previous market updates about the S&P 500. A better position might be there, but that would be a very early 40-day cycle, or possibly even over here, but that would be a very late 40-day cycle. Sometimes shorter cycles are very difficult to position, or at least the troughs of those cycles are very difficult to position because of the fact that a longer cycle has probably suddenly increased in amplitude, with the result that it overpowers that shorter cycle. The important point here, however, is that we were certainly expecting an 80-day cycle trough as indicated by this nest of lows at the foot of the chart. Another reason why we were expecting an 80-day cycle trough to form is indicated by the number of bars that have elapsed since the 20-week cycle trough here at the beginning of March. Here you can see there have been 64 bars, which is 64 days, because of course we do count the weekends. It's an important aspect of what Hurst discovered about the cycles that influence stock markets, is that they keep moving over the weekends. And so at 64 days, we would certainly be ready for an 80-day cycle trough to form in the markets. Why? Because the average length of an 80-day cycle is in fact 68 days. That is the average length that Hurst discovered over 50 years ago when he did this research into the stock markets, in particular the stock markets of America. And if you don't understand why the average length of an 80-day cycle is 68 days and not 80 days, I would encourage you to download the 10 core concepts of Hurst Cycles document, which I will provide a link to in the description below this video. And so there have been 64 days since this 20-week cycle trough at the beginning of March. That 64 days is counting up until Friday. Okay, so the point at which a potential trough formed in the market was just 3 days earlier. We can actually count the number of days by using our measuring tool, and there you can see there were 61 days that elapsed from the trough at the beginning of March to the low price on Tuesday. There is one final piece of evidence that we could consider here, which is the fact that the recent wavelength of the 80-day cycle has been 62 days. Because cycle wavelengths are dynamic and they expand and contract, we expect them to achieve an average of 68 days over many iterations, but we also keep an eye on the recent wavelength of that cycle, because there is a tendency for cycles to expand and contract fairly slowly. And so the recent wavelength of any cycle is important as a consideration. So again, when we were sitting at 61 days since the 20-week cycle trough from March, we were certainly standing by in preparation for an 80-day cycle trough to form. You will notice that Sentient Trader is not yet positioning a nice neat diamond below that trough, and the reason for that is because it is not yet absolutely convinced that the 80-day cycle trough has formed. I have often mentioned in these videos that diamonds, when it comes to Hurst Cycles analysis, are not necessarily a trader's best friend. You need to be trading on the basis of these nests of lows, these circles and whisker patterns, and you do not wait until a diamond has formed. Another way to increase one's confidence in the position of a trough is to take a look at some other markets. So let's do that. One of the principles that Hurst defined is the principle of commonality, which tells us that many markets tend to move with a great deal in common. When we are wondering whether a particular cycle trough is formed, it is often useful to look at other closely related markets. So let's take a look at the NASDAQ. The NASDAQ has a beautifully clear picture which has been unfolding, and the fact that there aren't any pins in the analysis, in other words, I haven't had to influence this analysis in any way, is a sure sign that the cycle action has been fairly clear. You can see the same 54-month cycle trough here in March of last year, the 40-week cycle trough, a good and clear trough, and here is the 20-week cycle trough at the beginning of March. If we zoom into this chart as well, you can see a very nice and neat nest of lows for the 80-day cycle trough, indicating that we certainly were expecting an 80-day cycle trough to form. If we measure the number of days up to that trough on Tuesday, you can see 60 days elapsed, slightly shorter than in the S&P 500, but if you look at the recent average wavelength at the right-hand foot of the chart, you can see the recent average wavelength has been 56 days. And so the time was certainly ripe for an 80-day cycle trough to form in the NASDAQ. Let's take a quick look at the Dow Jones. This is the Dow Jones Industrial Average, and here as well we can see a very nice and neat nest of lows for the 80-day cycle. Beneath this very subtle trough which formed in the Dow Jones, we also of course have the 18-month cycle trough looming ahead of us a little after the middle of this year. Let's cross the oceans. This is the DAX, the German stock market, and you can see we have a similar 54-month cycle trough forming in March of last year. We have our 40-week cycle trough at the end of October. Here is the 20-week cycle trough, which occurred in the final week of February, according to this analysis. And you can see there is a pin. I've had to influence this analysis slightly. But here again is our nest of lows for the 80-day cycle. Not nearly as neat as in the US markets, but it certainly indicates that the 80-day cycle trough was due, and here is our very nice and fairly clear trough that formed in that market. Might be worth just zooming in and taking a closer look at that. Here you go, you can see the nest of lows. You can see that it was a little spread to the left, which sometimes happens. It indicates that that 80-day cycle trough was getting a little overdue according to the recent average wavelength of the 80-day cycle, which in the German market has been as short as 52.5 days. In fact, the number of days that elapsed from the 20-week cycle trough in the last week of February was 67 days, only 1 day shorter than the average length of the 80-day cycle discovered by Hurst 50 years ago. And so here too, my confidence in the fact that an 80-day cycle trough has formed in stock markets around the world increases. Let's take a look at one more market. We'll take a look at the FTSE-100. This is of course the UK market, and here we have the 54-month cycle trough in March of last year. the 40-week cycle trough in October of last year. Here is a 20-week cycle trough. Again, I've had to influence this analysis. I think this is the best position for it. Also in the last week of February, here is our nest of lows. You can see that the European and the UK markets, both of them have recently been running fairly short on the 80-day cycle wavelength. And so both of those nests of lows are leaning over to the left. And if we zoom in to take a closer look at that price action, here you can see the trough which formed also on Tuesday. There's our nest of lows. There was a public holiday on Monday in the UK, I believe, and so we have the very likely position for an 80-day cycle trough over there. Now let's go back to the S&P 500 and consider what the implications are of the 80-day cycle trough potentially having formed in these markets. Of course, the first thing that we expect is that because the 80-day cycle and all cycles shorter than the 80-day cycle are now pushing the market upwards, we would expect price to rise. But what is going to happen in terms of this big trough that we are expecting, the 18-month cycle trough? That is, of course, a much bigger magnitude trough, so surely we expect price to come down. Well, yes, we do, but how is it going to do that? The way in which it is going to do that will be the result of the combination of all of the cycles as they influence the market. How does one do that? Well, there are various tools that we can use. For an experienced analyst, looking at the diamonds at the foot of the chart and these circles and whiskers is often enough. But another way of visualizing the analysis is by taking a look at the semicircles. Here we have each cycle represented by a color-coded semicircle, and you can see that all of these semicircles, the 18-month semicircle, the 40-week, the 20-week, are going to be pushing price downwards. The 80-day cycle semicircle is currently pushing price upwards. So that looks like quite a lot of downward pressure. But these semicircles, as I have mentioned in videos recently actually, can be fairly deceptive because they imply that prices are perhaps going to come all the way down to this base level, which is certainly not the case at all. And so as useful as semicircles are for visualizing the analysis, another tool is perhaps more useful, and that is the composite model line. I've presented the composite model line in many previous videos. This is the result of taking the analysis at the foot of the chart, which provides us with the wavelength and the amplitude of each wave of each cycle, recombining or recomposing that information into a line, and that is the composite model line. In the past, it is no surprise that it matches price action fairly closely because of the fact that it is calculated from the analysis that has been done on that price action. But the useful thing about this tool is that it shows us what this analysis should lead us to expect. And as I have mentioned in previous market update videos, the move down, as indicated by the composite model line into the 18-month cycle trough, is not a very big move down at all. But why is that? Surely an 18-month cycle trough should be a fairly big affair. Well, in order to understand that, we can take a look at another tool. The tool that we're going to use to understand why the next 18-month cycle trough might be a little disappointing in terms of downwards movement is the cycle line tool. I've mentioned that the composite model line is a result of combining all of the information about each one of the cycles. Well, that information can be displayed individually for each cycle. Here is the cycle line for the 18-month cycle. You can see how the amplitude of each 18-month cycle wave has changed over time. So let's take a look at some longer cycles and see what they are doing. Here is the 54-month cycle, and you can see that the 54-month cycle formed a trough in March of last year and is still very much heading upwards at the moment. What about the 9-year cycle? Here is the 9-year cycle, which according to this analysis last formed a trough in early 2016. As a result, the 9-year cycle should now be beginning to influence markets to move downwards. But now even the combination of those two cycles don't entirely explain the recent price action. So what are we missing? As I've mentioned, Hurst proposed that an infinite number of cycles influence financial markets, and yet this analysis includes cycles of only up to 9 years in wavelength. And so what about the longer cycles? Hurst recommended that the longer cycles be represented by something he calls sigma L. Sigma is the letter of the Greek alphabet that means in mathematical terms the sum of, and L simply means all longer cycles. Sigma L is calculated by Sentient Trader for every analysis, and we can also display Sigma L using the cycle lines tool. As you can see, it is a little different to the other cycle lines, and that is because it is the combined effect of all longer cycles than the longest cycle found on this chart. Let's clear those other cycles and consider for a moment what Sigma L is telling us. This blue line represents Sigma L, and when it is moving upwards, it indicates that the sum of all longer cycles are probably influencing prices to rise. When it is moving downwards, it indicates that Sigma L is influencing the prices to move downwards. As you can see, Sigma L has been rising fairly strongly ever since about 2009, 2010. What does that mean? It probably means that there was a cycle of much longer magnitude that formed a trough probably in 2009, and that is why we are experiencing bullishness that is not accounted for by either the 9-year or shorter cycles. Which brings us back to the 18-month cycle trough, which we are expecting to form later this year, because of the fact that the 54-month cycle is certainly pushing upwards, possibly even the 9-year cycle, if the 9-year cycle did form a trough last year, and probably also the influence of the sum of all the longer cycles than the cycles that have been found on this chart. All of those bullish influences are likely to mean that the fall into the 18-month cycle trough is not a very strong one. But of course, as price action unfolds, we will keep a very close eye on it and watch for signs of increased bearishness if they appear. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.